January 2, 2008. The Real Estate Capital Scoreboard January 2008. Chicago, Illinois, January 2, 2008. The new year triggers new hopes and fears as real estate capital markets continue readjusting from nearly a decade of uninterrupted volume and pricing momentum. While many investors fear new funding restrictions, others welcome more disciplined and customary underwriting practices deemed to be normal. December reflected continued uncertainty with the Fed dropping rates by a quarter point for the third consecutive time. Are more rate cuts in store for 2008? Will funds continue being more restrictive throughout the year? These and many other questions revolve around understanding markets as more clearly defined by different lender profiles. In other words, various lenders offer programs that don't necessarily converge in pricing and underwriting as was prevalent during the first half of 2007. In summary, the following key groups of lending platforms are available today. Banks, particularly European financial institutions, represent the most attractive floating rate pricing available. Overall spreads over LIBOR range as low as 170 basis points to over 200 basis points or more, depending upon the risk profile, leverage and property type. Banks are still relatively active for construction and acquisition loans. Agencies, Freddie Mac, Fannie Mae and FHA/HUD are the most competitively priced permanent lenders of any funding source in the marketplace. Overall pricing of 170 basis points or greater over comparable term treasuries is still available. However, multifamily properties are the only beneficiaries of such attractive pricing. Life insurance companies. Life companies have been the backbone of commercial property lending for more than 100 years. Permanent loans are priced in excess of 200 basis points over comparable term treasuries. Funds are available, although on a more limited basis as allocation benchmarks have been rapidly depleted as some borrowers move away from securitized loans. Most life insurance companies impose restrictions of 75% leverage with minimum debt service coverage ratios of 120% for traditional income properties including multifamily, retail, industrial and office assets. Mortgage conduits, by far, the most affected players in the marketplace during the past 6 to 8 months. Very cautiously funding permanent debt at pricing of at least 275 basis points over comparable term treasuries. Securitized lenders tread capital markets with great caution as daily pricing adjustments cause havoc for lenders trying to size deals with any certainty. According to Gary Duff, member of the editorial advisory group of the Real Estate Capital Institute, securitized lenders are not currently quoting deals to win. Instead, he notes, they will lend, but only under their terms.
February 1, 2008. The Real Estate Capital Scoreboard February 2008. Chicago, Illinois, February 1, 2008. Given the state of the market with gyrating interest rates, lenders are cautiously funding loans at well below last year's record volume levels. And while benchmark indices, for example, treasuries, LIBOR, plummeted throughout January, many lenders are requiring wider spread premiums to compensate for illiquidity and greater risk pricing volatility. Furthermore, rate floors are common, with the 6%+ emerging as a popular threshold. While the market is in a state of flux, the following debt trends are observed. Mortgage funds are readily available, although lenders are much more selective. Life insurance companies and banks are the backbone sources for most permanent and floating rate debt. CMBS/conduit programs are steadily recovering, cautiously funding loans with wider spreads of at least 300 basis points or more over comparable term treasuries. The Mortgage Constant and Debt Service Coverage Ratio guide mortgage underwriting standards, not purchase price, as lenders are reluctant to accept valuations in overpriced markets during the past few years. Lower level of investment-grade CMBS paper is relatively illiquid, AA to BBB tranches. The same story translates to the equity markets, which are unstable as sellers and buyers readjust pricing expectations in light of rapidly changing debt markets. Class A properties maintaining values as institutional owners are reluctant to sell well-performing core assets. buyers flocking to invest in major markets in a continued trend of flight to quality. 10% to 15% lower prices evolving for Class B and C properties, particularly in secondary markets. Multifamily, office and industrial properties in demand, retail assets more scrutinized in light of eroding consumer confidence. Vacant land transactions extremely limited and tempered by new construction costs, stringent pre-leasing requirements and investor caution. Jim Postwaller, a member of the editorial advisory group of the Real Estate Capital Institute, emphasizes, although we have seen a shift in pricing models resulting mostly from lender underwriting, reliability of buyer performance has emerged as a top priority, creating opportunity for groups that follow through on purchases. March 3, 2008 The Real Estate Capital Scoreboard March 2008. Chicago, Illinois, March 3, 2008. Availability of funds and correspondingly widening mortgage pricing dominate the real estate finance front. While mortgage funds are available, many lenders retreat from direct originations, instead preferring to purchase attractively priced CMBS securities. As such, mortgage pricing highlights are outlined as follows. Overall Treasury movement. Treasuries bounced 40 to 50 basis points during the month, settling about 25 basis point lower and 10 basis points, for 5 and 10-year terms respectively. Mortgage spreads widened dramatically, by as much as 50 basis points. Fixed-rate pricing. Loans are increasingly being priced based on floors rather than spreads or swaps. Most floors are in the 6% or higher range for 10-year permanent funds. Nevertheless, pricings reflect wide yield curve expectations, depending mostly on the funding source. For instance, life company spreads vary dramatically, starting about 230 basis points over comparable term treasuries. A substantial gap exists thereafter as Wall Street CMBS deals are priced on the high end of the curve starting at 500 basis points. Floating rate pricing. 3% floor for LIBOR is surfacing as a variable rates yield protection tool. Otherwise 170 to 225 basis points available to premium borrowers at banks. Real estate value-added floaters are priced 225 to 300 plus bps over LIBOR. Recourse traded for lower leverage with banks. Forward pricing, 60 to 90 days free, followed by 2 to 5 basis points per month, extending to 24 months total. Large loan premiums, 30 bits per second plus / premium for jumbo loans in excess of $100 million. Interest rate swaps. In light of expected lower rates, sophisticated borrowers are exploring swaps. As a result, interest rate hedging programs are gaining popularity, especially for shorter-term loans of 7 years or less. The Real Estate Capital Institute's advisory board member, Barry Moss, notes in many instances, current CMBS pricing reflects a discount for any security that is in a structure and is not reflective of the underlying real estate. He adds, the key is to do due diligence and understand the collateral, since depending on the quality of the underwriting and the specific vintage there can be issues.
The Real Estate Capital Scoreboard April 2008 April 1, 2008. Chicago, Illinois, April 1, 2008. March Madness defines current realty capital markets. While Treasury rates barely changed, about 10 basis points, lenders exercise extreme caution in a fog of doubt. Even as rates remain near historical lows, borrowers are baffled by substantially less favorable lending programs, including wider spreads, rate floors, and overall lower leverage. In particular, mortgage pricing is one of the key misunderstood variables for sizing loans today. A brief review and update on mortgage pricing are as follows. Swap spread pricing. Lenders favor swap spreads. Their movements account for Treasury spread volatility. Pricing is protected from unpredictable spread gyrations, as was the case much of last year. For example, a minimum spreads of in excess of 200 basis points plus a 10-year Treasury yields translate to longer-term rates of 6.30% or more. Baseline pricing. Obtaining the most competitive quotes in the marketplace normally requires calling various lenders and collecting the best quotes. Although this process is still common, lenders readily determine most attractive, risk-free realty debt pricing by checking with the commercial mortgage securities markets. Today, the highest quality, commercial mortgage securities, for example, 10-year AAA CMBS issues, trade in excess of 6.5%, the new benchmark for lender rate floors. Balance sheet pricing. While swap spread and baseline pricing models are popular, many funding sources rely on balance sheet metrics for pricing permanent debt, including banks, life companies, and agencies. Each of these sources have cost of funds that aren't necessarily indexed to bond markets or treasuries. The agencies, for example, are able to provide pricing below 6% for longer-term debt, well below traditional sources of capital. Several changes are on the horizon with respect to various pricing formats, including more conservative underwriting. While interest rates are relatively attractive, continued pressure on funding proceeds will drive lower leverage levels. Narrowing spreads and pricing. As bond markets gain more stability, narrower spreads are expected. Wider band of pricing. Within recent years, various types of properties, for example, lodging, multifamily, retail, were priced within a narrow range. As markets readjust, lenders will expect greater pricing premiums for different property risk profiles. More discipline will continue to drive debt pricing and capital market recovery. Dr. Timothy Radia, an editorial advisory group member of the Real Estate Capital Institute, suggests the long-term solution for improving capital market malaise is to educate and protect the demand side by encouraging moderation and safer practices. The Real Estate Capital Scoreboard - May 2008 May 1, 2008. Chicago, Illinois, May 1, 2008. The realty capital markets still are dislocated as investors try guessing the direction of interest rates and namely, mortgage spreads. While negative news abounds, the markets are actually showing signs of calmness as CMBS AAA securities and overall mortgage spreads continue narrowing. Key market highlights include rate movements. During April, any savings in mortgage spreads were absorbed by overall benchmark rate increases. Bottom line? Mortgage rates are about 25 basis points higher across the board. Mortgage spreads. As previously mentioned, spreads tighten permanent loans, resulting in 10-year mortgage pricing at nearly identical levels versus March. However, many lenders retreated from providing competitive 5-year loans by widening spreads as much as 50 basis points, resulting in minimal price savings between these two maturities. The E word: lenders demand equity in nearly every income-producing funding opportunity. Borrowers seeking maximum leverage are plagued with 65% loan-to-value restrictions and stringent debt service coverage minimums. Alternatively, loan-to-cost and refinancing of existing debt tests are added as extra performance thresholds. In other words, equity requirements override pricing considerations and other underwriting terms. Actual cash flow, pro forma income projections, and other future value economics are dramatically discounted as funding sources need to see actual cash flow. As such, new construction projects require substantial pre-leasing, for example 60% plus, and substantial equity, typically 30% on cost. Lenders are seeking flight to quality transactions with established borrowers willing to provide necessary recourse and guarantees. Yields. Now more than ever, investors expect to be paid for risk. Although exceptions apply, overall capitalization rates and return on cost yields have widened by at least 50 basis points or more. As for mezzanine and other higher-risk funding vehicles, double-digit yields are the norm. John Oharenko, a member of the Real Estate Capital Institute's editorial advisory group, remarks, without question, The most profitable and illiquid component of the real estate capital stack is mezzanine debt. In many cases, developers and property owners find it more attractive to lend mezzanine funds as opposed to directly purchasing properties. He adds, this phenomenon is short-term as more liquidity will return to the marketplace in the near future.
June 2, 2008 The Real Estate Capital Scoreboard June 2008. Chicago, Illinois, June 2, 2008. Despite unprecedented measures by the Federal Reserve, the credit crunch continues to spread from the housing sector to the commercial real estate sector. The volume of real estate transactions remains light and credit spreads have recently started to tighten while overall rates are rising, with the net effect of mortgage rates climbing about a quarter point. Return requirements continue rising as do construction costs, greatly limiting new construction projects. As far as key developments during the month, the following are noteworthy. Private equity. Raising private equity in light of lower conventional leverage is a top priority among developers. Most funds require at least 15% or more for value-add properties. Deep discounts. Most sectors within the conventional income property arena are faring reasonably well in maintaining pricing, with pricing off as much as 20% in some sectors. However, vacant land values have plummeted as new construction projects are nearly at a standstill. Discounts of 50% plus are not uncommon for motivated sellers. Fund supply. Given the vacuum left by CMBS lenders retreating from the capital markets, many life companies and banks expect limited fund allocations for the remainder of the year. Mortgage rates. While mortgage spreads over treasuries decreased by about 10 basis points or more, higher benchmark treasuries absorbed any gains as rates remain relatively similar, starting at 5.75% for terms of 5 years and longer. LIBOR-based funding is still available at lower levels, but reduced leverage and recourse tip the pricing scale. The Real Estate Capital Institute's editorial advisory group's member, Aaron Gruen, suggests the resulting reduction in new supply, continued export growth, and the Fed's highly aggressive monetary policy/fiscal stimulus should limit the scope and length of the effects of a real estate recession in many parts of the United States.
July 2, 2008 The Real Estate Capital Scoreboard July 2008. Chicago, Illinois, July 2, 2008. Nearly a year ago, the capital markets imploded as Wall Street retreated on a massive scale from securitized debt investments. By this time, most lenders were very closely pricing most types of income property deal as banks, life companies and CMBS sources crowded the markets with surplus cash. For a while mortgage spreads below 100 basis points over comparable term treasuries were common, even for full leverage loans. For example, in June 2007, the rate range was extremely tight for most conventional property types. Minor pricing differentiation existed among apartments, hospitality and commercial properties, even after factoring into account primary and secondary locations. All in all, properties were financed in the 6% plus range and slightly lower for premium quality properties with conservative leverage, in the 5.8% range. While mortgage spreads doubled during the past year, overall coupon interest rates on 5- and 10-year maturities are relatively similar. Today, even after accounting for higher spreads of 200 basis points or more over comparable term treasuries for permanent fixed-rate mortgages, rates start at about 6% and also may dip below this threshold level for extremely low leverage funding situations. The following table illustrates today's key market indices and overall rate ranges for income properties based on conventional leverage 75% or less. Once again, The above fixed-rate mortgage spreads can be reduced by about 20 to 30 basis points for low-leverage multifamily deals, particularly via the agencies. And while the rate range is extremely wide, lenders will distinguish and competitively price core funding opportunities in major markets much more so than a year ago. Higher leverage, secondary market properties are priced at the high end of the rate curve, in line with typical market conditions reflecting risk/reward premiums. Permanent loan term makes a difference, depending upon the lender. Some lenders differentiate mortgage spreads between 5 and 10-year pricing, while others set base floor limits. 5-year allocations are rapidly depleting as this term is popular with borrowers seeking more flexibility in anticipation of improving capital market conditions in the near-term future. As for floating-rate loans, banks continue quoting over LIBOR and swapping out the loans for borrower preferring fixed-rate debt. The best spreads using LIBOR start at about 180 bits per second. In a nutshell, banks are often about 25 basis points inside other funding sources for short-term funds of 5 years or less. For the most part, banks seldom offer 10-year fixed-rate loans. Enclosed is the June 2007 Real Estate Capital Scoreboard, which outlines rates from a year ago. Probably the most significant change in the marketplace relates to leverage, not rates. Today's full leverage deal represents 65%, whereas a year ago 75% to 80% was quite common. According to Gary Duff, advisory board member of the Real Estate Capital Institute, all in all, rates are still very attractive by historical standards. However, more equity is required to capture financing.
The Real Estate Capital Scoreboard August 2008 August 1, 2008. Chicago, Illinois, August 1, 2008. The realty capital markets remain surprisingly steady despite volleys of negative news about financial institutions and government-sponsored enterprises. Mortgage spreads are higher, but stable, with funds available for quality loans. Life companies and other balance sheet lenders continue funding deals based on similar underwriting as seen most of the year. Mortgage benchmark indices are stable as well. Treasuries are at nearly identical levels from a month ago, although notes and bonds bounced higher by about 30 to 40 basis points. In other words, no major changes in the capital marketplace in either mortgage spreads or corresponding benchmark yields. Hopefully, the rate stability will set the stage for return of the CMBS lenders in a meaningful way. Select Wall Street firms announced re-entering the marketplace by targeting overlooked markets based on funding mortgages in secondary markets, as well as funding more entrepreneurial properties. Overall rates remain similar to a year ago, albeit at substantially lower leverage levels. However, more subtle overall trends are evident, including the following. Funding sources provide competitive rates, but 70% or less of project value remains the norm for mortgage lending. Upward pressure on mortgage spreads as most active lenders meet funding targets for 2008. As 2009 approaches, fresh allocations along with some additional CMBS funds should create more liquidity. At the same time, competition from highest quality corporate debt is forcing mortgage yields to rise. Many funding sources demand 25 to 50 basis point premiums as compared to purchasing corporate bonds. Mezzanine and opportunity funds ramping up as first mortgage lenders tread with caution. Pricing on mezz debt starts in the lower teens. The large supply of bargain hunting equity capital is preventing any major pricing discounts from being realized. Equity returns are under upward pressure, but few sellers of prime properties show duress and are reluctant to transact below full prices. Properties continue performing. Overall equity yields for Class A core institutional properties trade from the low to middle teens, core plus assets trade within the mid-teen range, and opportunistic ventures offer returns in excess of 20%. Given illiquidity within the equity markets with few comparable trades, numerous lenders are setting valuation parameters for debt fundings. In general, the 7% to 8% capitalization rate range is a popular appraisal benchmark for higher quality commercial properties in most markets throughout the country. Multifamily properties start at 5.5% cap rates. Loans in excess of $50 million per property generally require funding syndications, as only a handful of domestic lenders are active in this arena. New, speculative projects feature substantial equity of 40% or more of cost. Development deals limited to finest projects with substantial pre-leasing, 70% or more, with established sponsorship. Jim Postweiler, advisory board member of the Real Estate Capital Institute, suggests buyers and sellers are still reluctant to transact, mostly due to stingy debt markets. However, signs of improvement are emerging as buyers realize few opportunities for core properties are available.
September 1, 2008 The Real Estate Capital Scoreboard - September 2008. Chicago, Illinois, September 1, 2008. Throughout August, financial markets digested news about problems in the financial services sector. Real estate was no exception, with government-sponsored agency woes capturing daily headlines. And while unfavorable news dominates, capital continues flowing, although certainly with more caution. Major realty finance market highlights today are as follows. The 5-year and 10-year treasuries dropped just under 20 basis points. Fixed-rate spreads for portfolio loans of all terms have increased by at least 20 to 40 basis points across most funding platforms, including conventional and agency debt. 65% to 70% leverage remains the maximum standard for permanent loans. Mezz funds bridge the short-term gap to about 85% with yields of 12% or more. Unless loans are committed and approved with rates and other terms locked, daily market volatility prevents many funding sources from grandfathering of loan terms under negotiation. Pro forma and projected income streams avoided in favor of actual income as underwriting benchmarks for existing project fundings. Hedge funds continue replacing banks for structured short-term floating rate debt. Loan syndications required for larger funds, as limited sources exist for loans of $50 million or more. Overseas banks, mainly European, active in providing larger-scale letter of credit and other financial enhancements. Re is the most common buzz realty finance word, including remargining, renegotiating, rebalancing and repositioning. Sellers are avoiding placing the asking prices on properties, fearing loss of a potential buyer. Quality properties still in demand, secondary markets dramatically affected by lack of liquidity. Advisory board member of the Real Estate Capital Institute, Skip Perry, notes low leverage begets low volume. Adding, until funding sources are more comfortable with financial market stability, debt and equity players will stay close to the sidelines. The Real Estate Capital Scoreboard - October 2008 October 1, 2008. Chicago, Illinois, October 1, 2008. It's a good news/bad news real estate capital marketplace. Mortgage markets are plagued by Wall Street market malaise and swooning prices, yet as far as commercial real estate debt is concerned, overall default rates and profit performance remain at historically favorable levels. Funding sources and borrowers alike are very selectively funding and acquiring projects as repricing opportunities emerge in the wake of one of the nation's worst financial crises. Dramatic market volatility created by major financial institutions failing along with selective governmental bailouts wreaks havoc with real estate capital markets, with some key trends developing, including skyrocketing LIBOR pricing, with rate premiums, now closely reflects domestic bank prime rates. Funding availability is the primary factor within the lending sector, surpassing pricing and leverage as key variables. Numerous balance sheet lenders are temporarily suspending quoting on new transactions as market repricing continues, for example catching a falling knife syndrome. More funding sources are returning to pricing loans based on absolute net yields versus spreads. New construction commercial property financing is nearly at a halt, unless a substantial policing is available to credit tenants with pre-leasing required positive debt service coverage. Lending remains extremely restrictive, particularly for non-conventional property types such as lodging, special purpose and recreational properties. Commercial properties, retail, office and industrial, conservatively financed with maximum leverage of 65% based on capitalization rates in the higher single-digit range. Multifamily properties remain the most desirable and attractively priced funding opportunities in the capital markets as leverage levels remain close to historical norms and pricing spreads are in the mid-200 basis point range over comparable term treasuries. Government bodies including Freddie Mac, Fannie Mae and FHA/HUD continue providing competitively priced mortgages for this sector. Borrowers are bridging equity gap by providing personal guarantees and additional collateral, perfectly with commercial banks. Buyers and borrowers who are active in closing deals are rich with liquidity. Many use recourse and additional collateral to successfully finance projects. According to Jeff Davis, advisory board member of the Real Estate Capital Institute, except for select agency programs such as FHA/HUD, most funding sources are waiting for more clear market signals for the remainder of the year. He adds, active lenders seem to have met their allocation goals as funds continue drying up within the securitized lending sector. The Real Estate Capital Scoreboard - November 2008 November 1, 2008. Chicago, Illinois, November 1, 2008. The commercial real estate capital markets are tightly strapped into the Wall Street roller coaster with rates jumping up and available funds tumbling down. During the past week, mortgage pricing has been rapidly climbing based on spreads over comparable term treasuries. Key market highlights are as follows. About 80% plus of the traditional funding sources, life insurance companies, pension funds and banks, remain sidelined, waiting for more capital market stability. 5-year permanent loans are frequently breaking the 7% mortgage rate barrier, translating to spreads of about 400 basis points. 10-year loans, the most common term, are priced 7.5% or more. Exceptions apply. Prime multifamily and commercial properties with limited leverage of 50% or less, pricing occasionally reduced by as much as 0.5%. Lenders will only seek conventional property types, apartment, industrial, office and retail, projects with story shunt. Funds are still selectively available for refinancing, with a loan restriction of 65% plus LTV. As a comparison, today's commercial mortgage terms and conditions reflect pricing not seen since the beginning of the decade. See historical mortgage rates posted since 1983, http://www.ratesdata.com. However, leverage levels and funding availability are substantially less favorable than that time as owners must post at least 10 to 15% more equity. December 1, 2008 The Real Estate Capital Scoreboard - December 2008. Chicago, Illinois, December 1, 2008. The Fed's aggressive action of pumping more liquidity into financial markets is starting to reinvigorate real estate lending. Helped by TARP funds, select financial institutions are offering competitive short-term loans. Furthermore, the Treasury yield curve moved downward by about 0.5% during the past month, easing overall pricing. Current income property mortgage pricing and underwriting trends are outlined as follows. While liquidity remains a key concern, overall interest rates are moving downward. Despite wild fluctuations in key indices, for example, LIBOR, Keeping track of pricing is becoming less challenging as numerous funding sources impose rate floors. Floating rate debt starting at 5% is among the most competitive pricing options available, while most types of longer-term financing start at 6%. Subsidized by agency funds, multifamily properties attract the lowest price debt, while office, industrial and retail properties capture pricing that is at least 25 to 75 basis points higher. Debt service coverage restrictions start at 120% for acquisitions and 125% or more for refinancings. And while debt service coverages remain somewhat constant, shorter amortization schedules of 25 years or less are used as additional underwriting safety measures along with overall lower leverage underwriting of 65% of value. Apartments are still funded in excess of 70%. The Real Estate Capital Institute's advisory board member, John Oharenko, comments pricing discussions are returning to absolute rates, rather than quoting spreads. He argues that the limited universe of active lenders fully dictate terms, including establishing minimum pricing thresholds which are not necessarily linked to specific indices such as treasuries or LIBOR. Oharenko adds, expect to see lower mortgage rates for 2009 as the Fed continues a monetary blitz of helping banks and other financial institutions return to the market to recreate more competition and liquidity.